Namaste. A very good afternoon to everybody from warm Melbourne here. And I thank Sangam Talks providing this opportunity to share this interesting research that I've been working on for the last couple of months. So we've titled this talk as Unveiling the Dragon's Hold on Indian Economy. And this was done with the help of our research assistant, Sanya Srivastava as well. A little bit about me. I have over 25 years experience in IT industry. I've worked for large corporations like Infosys, Wipro, GE, and Target, and now in Telstra in Australia. And I've published award-winning papers. I've also been technology speaker in many forums, but my real passion is actually technology and economy. And this is where this sort of a topic falls into my area of interest. Obviously, India and China have been in the news for the last couple of months, I guess. You've been following the global ban of apps, specifically in India. You've looked at the news between the armed conflict that's happening between the two countries in the Ladakh region. You've also looked at other economic warfare news that are coming up. So this topic becomes very relevant for all of us, not only as citizens of the country, but also many stakeholders for making decisions. So this talk would probably provide them more input into the data behind the scenes, the actual economic decisions that are being made, and how this is actually affecting the trade relationship between India and China. What we've done, typically, as Taniji mentioned in the beginning, you would have seen certain talks focusing a little bit more on geopolitical scenarios or armed conflicts. What we have done is we have taken an interdisciplinary domain approach. So we're looking at multiple domains that could impact this relationship. So we start with economy, we go to bilateral trade, we look at investments, we look at the debts between the two countries, we look at media, and also we look at some other notable industries, including obviously politics. Our presentation today is largely broken down into 6 parts. So we started with a little bit of background on the India-China trade relations, and we look at a little bit deeper on China's One Belt, One Road initiative, which I think everybody would have heard if you're following the news. We'll then look at China's investments in various Indian sectors. And this is not just the trade that we talk about, it's actually the investment of China in India. And then we also look at India's attempt to make investments in Chinese sectors in their country. And obviously, what could we do to look at the trade imbalance? And what are the key findings and questions that can propel further discussions and conversations? So if you look at it, China and India have been pretty ancient civilizations for the last 2000 years. And we have been sharing many economic relationships and trade relationships since the foundation of both the civilizations. What you see on the top left-hand side is a chart that sort of charts the GDP since the first century AD. And as you'll see, the combination of India and China was contributing to over 60% of the world GDP. And as you see, India was actually a top better than China because it was contributing to over 35 to 40% for nearly 1,700 years from the year 180 onwards. As you start seeing the graph, which is sort of in the orange color, you will see that the contribution of India to the global GDP start to shrink very rapidly. Some of the reasons that can be attributed are the Mughal invasion of India from the 15th century onwards, which dropped the India's GDP contribution to almost 15-20%. And it's at that point that China started to overtake the contribution to world GDP. Further, due to British colonization of the Indian subcontinent from the 18th century onwards till almost 1947, where over $45 trillion of wealth was siphoned out of India, our contribution today is much less. Our combined contribution is probably around 20% of the world GDP. And the graph on the below sort of charts the same relationship across 4 different main continents or countries, as I call it. So as you can see, we've had some competition in the last couple of centuries, but at the same time, we've had very different outcomes at the end of these two time periods. If I just focus on the India GDP in the last 30 years, it's shown very high variation. So what you see on the top right-hand side is India's GDP in the last 30 years. You'll see that it is sometimes up, sometimes down. There's quite a lot of variation in the data, but you do see some stability starting from around 2002 and continuing all the way to 2008. Now, obviously, with COVID, this data is changing pretty rapidly. We're just waiting for the economic data to come in so I can enhance this graph much better. Now, from 2012 to 2016, there was a decline, and only since the last years have we now settled down to around 6.8% as a GDP. Now, if you look at China's journey in the same time period in the last 30 years, they've had very choppy start, but you'll see that from 1990 onwards, China has had a very smooth GDP, which means their economy is a lot more predictable in terms of what they can generate as output. But you'll also see that in the last 10 years, there has been a steady decline. And surprisingly, both the countries now have settled around 6 to 7% as the global contribution to the world GDP, which is sort of very strange looking at the journey that both countries have taken. The other one that's very interesting to look at is the debt from financial institutions, and these are world financial institutions. So if you look at India, the gross domestic product is around $2,800 billion as of 2019. And this represents around 2.31% of the world economy. But the cumulative debt that India has raised from international financial institutions is around 564 billion, which means our debt value represents almost 20% of our GDP. And you can see that there's a steady increase of debt since 1991 with a little bit of drop in 2017. Just keep this graph in mind because it will become very relevant when we do a deep dive into the debt scenario that India and China have. Now, comparing the trade deficit, which is, I think, has been talked a lot by various news channels, is the actual economic trade relationships between India and China, basically what we import versus what we export. Now, if you see the graph over the last, again, 40, 50 years, you'll see that our trade deficit was quite balanced until the 1990s. And then you'll see that the two countries have taken very different trajectories. The one on the top, which is in the orange, is China, and the one in blue is actually India. Now, you'll see that China has always maintained a positive trade balance for the last 30 years, with only some downward trend during GFC, starting around 2007. And then in the last 5 years, there's been another downward trend. But still, what is surprising to know is that compared to India, they've always exported more than they've imported. Now, if you look at the journey that India has taken, on the other hand, we've always had negative trade relationship with China, which actually worsened after 2000. And I think one of the rock bottom that we hit was around 2012, very closely followed by 2019. What I've heard, though, from the latest numbers that are coming through is that there have been some decisions made that have made this positive or neutral, at least by 2020. But I wait to see for the financial year to complete to sort of give a better view of what is happening. It's quite interesting to see that even though we have been such long trading partners, that China actually exports more to us than we export to China. Now, if you look at India's trade with China, so we're just looking at what India is trading over the last 20, 30 years. 2010 and 2015, you'll see that there has been a significant increase in the trade relations. And there was an all-time peak reached around 2011. And then you'll see that by 2017, there was a little bit of drop. And then from 2016 onwards, there was an increase. Now, you'll see many news channels coming and saying that this was the Congress period versus the BJP period. What is very surprising to see is that irrespective of the elected government, the trade policies that are driving this sort of a graph are almost the same. So from 2008 to almost 2015, we've had a steady increase with many peaks. And then from 2016 to almost now, we've had some steady increases in trade with a little bit of drop in 2020. So trade value with China stands around 84.44 billion. And in this, 52 billion is actually India's trade deficit. That means China exports more by $52 billion. By 2018, our exports to China was 13.33, and the imports were around 76.38, with a trade deficit of minus 63 billion. So India's, of all the countries that India has a relationship with our relationship with China is the single biggest trade deficit, and it's been continuing for the last 20 odd years, as you can see from this graph. So don't let the political, the propaganda that comes out saying we have done differently. We haven't done anything different in the last 20 years. Now, sort of plotting the data between China and India trade with what you see on this graph here. So what you see on the orange is the China's trade, and the blue is India, and then the gray is actually the trade deficit. So very clearly, you can see that in the last 6 years, not much has changed. China has still continued to grow. What is interesting, though, is that in 2017, Hong Kong's trade deficit was around 3.9 billion, and it increased from 2.7. So even though our trade deficit with China dropped, but it increased through Hong Kong. So what has been the guess is that even though China has stopped trading with us, now they're using Hong Kong as a trading route. So it again continues to increase the trade deficit with China because we're buying the same products just from a different channel. And the sharp rise in Hong Kong export raises a lot of speculation and questions. Whereas India's import from China has decreased to 68, but the combination of Hong Kong and China begs to ask more deep dive and more questions in this area. Our guess is that China may be using Hong Kong to camouflage the real size of its export to India, while continuing to maintain the trade imbalance. If we also now look at what we import versus what we export, we import almost 14% and export China is around 5.3%. But if you look at the type of imports that we do, we look at electrical machinery, equipment and parts, nuclear reactors, boilers, machinery, organic chemicals, project goods, articles of iron and steel, plastics and articles. So these are a combination of raw materials, but also high-end finished products. And if you look at what we export to China, you look at ore, slags, ash, cotton, copper, mineral fuels, mineral oils, plastics, and iron and steel. So our predominant trade relationship with China, if you look at the top 20 articles that we import and export, we end up shipping more raw materials and we end up importing finished products. This was very much the same model that British used to operate with us through the East India Company. And it is quite shocking to see that we have learned nothing from this and we're continuing to make the same mistakes. I'm going a little bit deeper into the import and import commodities now. So if you see the import commodities in the last 10 years or so, you will see that plastic articles, iron and steel, nuclear reactors, and other electrical machinery are all on the left-hand side. What you see on the right-hand side is also the growth rate. If you can see, although there are few articles that have changed in terms of the growth rate, pretty much it still remains positive for many categories like the items marked in green, which is iron and steel. So we're still exporting a lot of raw materials. So higher end finished products come to India, but lower end products go from our country to them. And the rate hasn't changed much. And if you look at the export commodities, what we export to China and what we send to China, you'll see iron and steel, plastic articles, organic chemicals, and those sort of ones. And you'll also see a pretty big drop in the item which is marked yellow, which is the mineral fuels, oils, and other raw materials. So what China is also now doing is they're starting to stop importing some raw materials from us. So not only are they continuing to import more and more higher end products to us, they're also stopping to import lower end products from us for their raw materials, which is also starting to hurt our trade deficit, which is why you see that it is still negative after many years. And if I can summarize the trade imbalance, you'll see that our trade with China trades around 16.3 billion and our trade relationship is around 69 billion. So we do lower end exports and with higher end imports. Our market access have impediments for agriculture products and competing sectors. So for example, you would have seen that in the top 5 or top 6, India is a big exporter of pharmaceuticals and IT services, but you'll not see them in the top export categories from between India and China, which itself is a huge detriment for what we have to offer to the world. And if you look at the overall trade percentage has just increased to 5.33 and import percentage has increased to 14.1. So nothing much has changed to rebalance the trade in the last 20 years, and especially in the top 20 categories. And India's imports from China have completely dominating our trade relationship, which is also indicated in the trade imbalance that you see. Now, what are the questions that this sort of a data analysis reveals to us? One is, should we continue to have the same type of relationship with China in consideration of the fact that other territories where China has control, and these ones include Hong Kong, Taiwan, Tibet, Pakistan, Nepal, Iran. So should we now consider our trade relationship with China by considering all these other countries as well? And why have we allowed such a massive trade deficit to build over so many years with no control mechanisms being put in place? Have we really redefined or rectified the trade agreements to balance the trade? And why trade agreements always seem to benefit China while leaving India at a disadvantage? So these are some important pertinent questions that come from the data that I've showed so far. I'll change the gear a little bit here to go deeper into something we call as the Belt and Road Initiative, which is also China's trade superhighway. Now, Chinese economic and strategic agenda is to build a global infrastructure network. So what they're trying to do is connect one end of the Eurasia, Africa, Oceania to two different routes, one over land and one over the ocean. Now, China and supporters claim that this is an economic aid and is basically provided to many economies to boost their economic status, while many critics say that this is more to facilitate Chinese economic and strategic domination of countries. And if you look at a little bit deeper into how the routes are coming up, you'll see that the road goes all the way from Spain to the other end of China. You'll also see that the sea route also goes through Egypt. It goes through Sri Lanka. And surprisingly, I also see Kolkata in there. I didn't know that Kolkata had signed up for Belt and Road, but it seems to be on their plan. And they go all the way around Malaysia, Indonesia, Vietnam. So in route, this is almost a pretty massive network of economic trade route that is being built. Now, there have been some feedbacks and some repercussions of this sort of an economic trade route. Now, China has not been able to persuade India to sign on the One Belt, One Road initiative, although they have been successful in forging trade agreements with all our neighboring countries, which is also starting to isolate India from trading with these countries. Japan, United States, Australia, and India have been highly critical of this initiative, and we are calling it a debt trap diplomacy. So if you look at the summary of what OBOR has achieved, they've got around 75 overseas economic and trade cooperation zones in over 35 countries. Bank of China, which uses the Chinese currency as is the main bank that is behind this initiative. And China is purchasing mines as well as power generation transmission projects right across the belt or across the states where the economic belt is going through. Now, which means that there's massive financial assets being deployed. There are long-term control of infrastructure, natural resource, and land assets in all these regions. Plus, there is also a very desirable credit terms for infrastructure loans being provided by Bank of China. Now, transfer of the Chinese own production capacity to these countries where production is cheaper is also happening at the same time. And China is now able to exert more control over local markets and labors and export policies as well. Now, this almost creates a sense of being encircled and the danger of further imbalancing the trade relationship within India and through the neighboring countries as well. One of the key things that we have seen is that many researchers already revealed that infrastructure actually doesn't build economy. It's the economy that creates the need for infrastructure. So by implementing the infrastructure first, we really don't know if this is the way to build the economy or is this going to create a massive global financial crisis for all the countries involved in this initiative. Now, what are some of the questions that are raised by such an initiative? Now, can the success or failure of the Belt and Road Initiative be actually be measured? So far, we've just heard media news reporting one way or the other. And how will India really rebalance trade if all neighboring countries become part of the Belt and Road Initiative? Although we have been opposing it, but if all our neighbors become part of it, it almost becomes an encircling strategy. And what can India do to help the neighbors? As you know, you would have heard of Sri Lanka and other countries asking for loans. Are there better credit terms that we can provide to our neighbors through SAARC and other such associations? And how can international agencies be leveraged to negotiate certain unwanted aspects of the initiative to be taken away? So including things like slavery or economic dominance of certain regions by giving loans at very low rate, but then buying back the entire asset when they fail to return the loan. Now, I'm going to look at Chinese investment. So far, what we saw was the history of India-China relationship, and we have looked at trade relations. The trade relations have got a lot of media attention, so many of you would have been aware of it. This starting section looks at how much China has invested in Indian sectors. So if you look at all of Chinese investments, some of the top sectors that come out obviously is real estate, technology, infrastructure, automobile, online education, media and content, and healthcare, totaling almost $36.6 billion investment. As you can see, obviously real estate takes a big chunk. I don't think many of us have actually heard of what these real estate investments are. Technology has been in the news for various reasons in the last couple of months, so you'll probably be more aware. Infrastructure is another one. You'd have heard of a few news items coming out here and there. Online education is also another big one. Now, Chinese investments and contracts in India exceed $36 billion. And this has not just happened in the last 5 years. This has happened in the last 15 years. And what is surprising to know is that over $15 billion got invested in just the last 5 years alone, which means that investment almost doubled in the last 5 years in the Indian sector. And I'm going to start going a little bit deep on each of the sectors that we talked about. So if you look at real estate, there are new emerging interests for China, so their domestic market is starting to slow down. If you remember, the overall GDP also was slowing down in China. So they are seeing a slowdown in real estate, whereas in India, it is quite healthy and looking upward. So China is seeking to invest more and more. The China Construction Third Engineering Bureau, or CCTB as it's called, is now backed by the state, by Construction Engineering Corporation. The partnership with Gurgaon-based Tulip Infratech project for $288 million has a 3-year plan for housing, road, highway, and other infrastructure projects. The Fosun Group is very close to acquiring a 51% stake in a Bengaluru-based real estate firm for $115 million. And CNTC, which signed a joint venture with Golden Gate Properties for residential projects in Bengaluru is worth around 360 million. And CNTC has $1 billion 2-year investment plan already in India. So if you look at the top grades, China Fortune Land Development sort of stands from the crowd from everyone else. And this is also backed by the state agency of China. If you look at technology, obviously this has been in the news, but what will be very surprising to you is that the top startups in India, technology startups, 18 of the 30 Indian unicorns, for example, with over $1 billion investments have China-backed investors. Out of 118 startups with less than 10 years, they have over $5.6 billion Chinese funding. Some of the big names that you would have heard is Big Basket, Flipkart, Zomato, Paytm, Ola, Oyo, Udaan, Snapdeal, and even Dream11. And they have Alibaba, ByteDance, and Tencent have funded over 92 Indian startups. And 4 out of every 5th smartphone that originates in India is actually from China. So Xiaomi, Vivo, Oppo, and Realme have got $16 billion sales in India. Xiaomi and BBK Electronics have combined $504 million investments in India in 2019. Huawei has announced another $100 million investment in 2019 in India. Oppo and Xiaomi have 3-year plan to invest $260 million. And 44 of the 100 popular most Android used apps are all used by Indians are all from China. And China have almost 66% share of the smartphone market, which means they have over 610 million cell phone users as of today. And these numbers are growing every day. Even the UC browser, which is very famous for the Alibaba platform, has got over 17% mobile browsers. And TikTok, which is owned by ByteDance, has actually overtaken YouTube until it obviously got banned by the Indian government. If you look at the mobile gaming market, you would have heard a lot of debate on this with 5G and other news that have come up. But you'll be surprised to know that India is the second largest smartphone market in the world after China. And a whopping 77% of these smartphones are regularly connected to internet, which is greater than the entire population of the United States. The online gaming in India has had the highest growth in 2019 with almost 40%. And Yuzu Interactive is now investing almost $10 million in the Indian gaming industry. As you can see how India stacks up to China, China has a lot of action and strategy games where India developers are focusing more on the board games, very less on the role-playing games. But the recent ban on some of these gaming platforms does provide a great opportunity for Indian gamers to catch up with the Chinese game content creators. The next one is infrastructure. Obviously, this one, I'm not going to read through all of it, but you can see that SANI, China Association of Small and Medium Enterprise, the Dalian Vander Group, the Zixing Group have all invested significant amount of money in millions of dollars in India. I'll mention a few key ones, which is that even the Adani Group, which has the Australian coalition that is trying to build the coal mine in the Great Barrier Reef, has actually secured $16 billion loan from China. So it would be very surprising to know if we win the contract, whether Indians have won it or actually Chinese companies have won it. The Chinese firms have shown a key interest to participate in the Sagarmala and Bharatmala plans, which is a plan to build 142 cargo terminals at major ports in India. So if these Chinese firms also get control of our ports, which also means this will now become part of the One Belt, One Road initiative. There was a 3 trade agreements worth $40 million that was signed by the Maharashtra government with Chinese-backed companies, which actually got put on hold due to the border conflict, and it was picked up by many news channels. The Chinese East Hope Group has invested $300 million. The Dongfang Electric Company has invested almost $2 billion with a 5-year plan for power generation. So as you can see, infrastructure is a huge area for investment for the Chinese companies in the Indian sector. So the surprising thing is the market is Indian, but the investment is from Chinese. So when our economy grows, it's not the Indians that make the money, but it's the Chinese-backed, state-backed companies that make the money. If you look at the automobile sector, so Dongfang Electric is one of the biggest investors. So SAIC has announced around $288 million investment to expand an older GM plant. SAIC has also announced plans to enter into mobile motor vehicles market through MG Motors brand with $350 million investment. And BYD is partnering with the Hyderabad-based Goldstone Group to invest another $28.8 million in a greenfield facility. So again, automobile industry is a growing sector for India. So it is interesting to see that China is also showing a keen interest in this sector. There were a lot more other industries, which I didn't want to go into details because there's quite a lot, but there were some notable ones which I thought will be interesting to share with all of you. So if you look at pharmacy, which is one of our major exports to rest of the world, there was an acquisition of $1.1 billion by Gland Pharma, of Gland Pharma by Fosun in 2018, which is the largest Chinese investment in India. So they are taking a key interest in all our major exports segments. If you look at media, ByteDance, Tencent, Xiaomi Inc., and TikTok platforms all have Chinese investments. So Daily Hunt, even Ghana, which was founded by Times Group, got acquired by Tencent. And digital media also got acquired by Xiaomi. So even the songs that you listen to, when you're listening to songs, it's the Chinese companies that are making the money. Many have actually asked, why doesn't China have a cricket team? Well, they don't need to, because they are actually sponsoring the Indian cricket team. So the recent IPL that got completed, although the branding for Oppo was removed, there was a $155 million deal that was signed. But now they have sort of moved the deal to Baiju, which is again backed by Chinese companies. And Vivo successfully bid to sponsor the Indian Premier League for $317 million. Again, I didn't watch the IPL. I'm assuming there was some level of marketing and branding done through the IPL games. Baiju, which is one of the emerging online education platforms, is heavily funded by Green Atlantic, which has got investors actually from Beijing, Hong Kong, and USA, which also means that they are now able to influence our education sector and what content is being created for our children in India. If you look at tourism, in 2018, 140 million people plus or more than that actually were outbound tourists from China, but only 225,000 actually visited India, which means even though we have invested a lot into road shows and investment into Chinese tourism, we have not really drawn a lot of tourists into our country. And Chinese special tourism model is also being pushed into India, although not very overtly, it's quite happening behind the scenes, so to say, which has been shown to be not at all sustainable from an SDG perspective. And Chinese state-owned cruises have starting to heavily invest into global tourism packages, which is also starting to affect Indian tourism companies. The last one is telecom, which is the US, UK, Australia, and Japan have actually blocked Huawei from rolling out their 5G plans. Obviously, India is currently trialing 5G, but it's interesting to know that we have blocked Huawei from acquiring our telecom airwaves as well. Now, what are some of the interesting questions that come out from this? So if critical infrastructure, real estate, technology, and telecom are all controlled or influenced by Chinese investors, how can India actually stay competitive globally? And the other part is China is shutting off foreign competition. China has been able to foster a very close platform for development of its internal tools and capabilities. Now, should India consider something for this? And I think the Make in India campaign that Mr. Modi is running is starting to focus on something very similar. Is it possible to monitor and can India really control the propaganda and censorship and misinformation when Bollywood, media, news channels, and platforms like TikTok are completely and heavily monitored by Chinese government? And who really creates and owns and controls the digital data, whether it's customers, payments, messaging? If you look at Paytm or even your travel information by using Ola, when all these ecosystems send data back into Chinese government. And how should India manage and monitor Chinese investments into various sectors that we talked about? If China has got investment into very critical infrastructure projects and contracts during wars and areas of conflict, will India really be able to negotiate and appropriate terms and conditions for any negotiation that may happen? And the bigger question is, why isn't India able to generate the investments needed for organic growth? Why are we looking at international funding? We are one of the largest economic countries in the world with over $2,800 billion in GDP, and yet we are very dependent on foreign investments to encourage our own companies to grow. And how can Indian government actually enable better investment-friendly local ecosystems with local investors? And can India really protect its digital borders? The Chinese debt is another interesting aspect that I wanted to touch upon today. So if you look at some of the banks, the Asian Infrastructure Investment Bank, or the AIIB as it is called, has actually approved a $750 million loan to India that's co-financed with another bank called ADB for expanding the social safety nets for the needy and strengthening the country's healthcare systems. AIB has also loaned $500 million for COVID-19 emergency response. So what is key for us is, do we really need this sort of a funding from a Chinese bank? Anil Ambani's Reliance companies actually borrowed loans from Chinese banks for purchasing equipment, and they owe around $1.33 billion for refinancing short debt and over $600 million to buy equipment from Huawei and ZTE. Now, PCB, which is the People's Bank of China, has raised stake in SDFC to 1.01% from 0.08%, which is almost $1.59 billion. And NDB of BRICS has loaned around $224 million to build the Assam Bridge and $260 million for the Mumbai Metro. Now, RBI has issued a license to Bank of China to operate in India, and People's Bank of China has also picked up stake in ICICI Bank. So this sort of a Chinese cheap debt plus impose restrictions for the fact that if we get a loan, as has happened to Reliance, that you also must buy the equipment from China, completely eliminates any local competition, which also creates a very unhealthy environment for local Indian financial institutions to thrive in India. So the Chinese banks will thrive in the environment that is being created for Indian economy. So what are some of the final questions that sort of come from this analysis? Why aren't Indian banks and debtors able to provide the low cost financing options that Chinese banks are able to provide? And how does India actually benefit from this cheap currency, low cost financing and conditional purchase options that China is providing? Will China push to internationalize its currency for all the debts provided? So imagine if you take the loan in dollars, but you're actually asked to repay it in Chinese currency, which also means that Indian rupees will fall against the Chinese currency. When disputes arise between India and Chinese entities, can Chinese lenders leverage their enormous hold on Indian companies to settle disputes in their favor? And in eventualities of security concern and conflicts, will the space for Indian agencies to establish the case get constrained if Chinese lenders extract their pound of flesh from the Indian companies? In the absence of disputes, Chinese lenders, principally CDB and the China Exim Bank, have been known to advance Chinese strategic interests. Now, how can Indian strategic interests be met under such conditions? Now, is there a link between the strategic ambitions of Chinese government and the commercial interests of Chinese firms? Because the financing it provides to support cross-border deals connect the state policy to commercial activity. This may not even be legal in many countries, and should we then allow other countries to even practice it? This was a question that Erica Downs raised at the John L. Thornton China Center research at Brookings. We'll change the gear again now, and we'll look at India's attempts at investment in Chinese sectors. So if you look at the dominant sectors that India has invested, they go from manufacturing, healthcare, financial services, a little bit of IT and BPO, telecom, logistics, and business consulting. So Dr. Reddy's laboratories have had a presence in China through some joint ventures like Aurobindo Pharma and Sun Pharmaceuticals, also along with them. Tech companies like Infosys, TCS, Wipro, HCL, Mahindra, Inmobi, and NIT have set up offices in China. Recently, Patanjali and Organic India have also made forays into Chinese markets. ICICI, SBI, and Axis Bank have had presence in Chinese market for a long time. And Mahindra and Mahindra and the tractor company have had joint ventures for many years to come. I'll go a little bit in details into some of these investments. So if you look at pharmacy, Dr. Reddy has generated over $30 million revenue through the product sales through the JV in China in just 2019. And Dr. Reddy has also identified 70 products that actually meet and can obtain approval in the Chinese authorities in the coming years. Dr. Reddy's is building a new plant, upgrading teams and building a pipeline for China. And Aurobindo Pharma is next in line to construct a facility in China, expecting commercialization in the next 2.5 years. In the manufacturing sector, M&M or Mahindra and Mahindra has set up a joint tractor venture, which has got a production capacity of 8,000 tractors. I wasn't able to get much details in terms of financial numbers. It would require far more research and more opening of the publicly available information regarding these initiatives. Same with the organic medicines. Although we did significant amount of research into Ayurvedic products, we couldn't get any indicative financial numbers as to the size of business of these companies in China. Now, the IT and ITES, which is also another big export category for India, you'll see that Indian companies have been able to hire only around 25,000 people in 10 major cities till date, and only constitute 3% of the global revenue. Now, Tech Mahindra has been in China since 2002 with over 200 projects. And in FY19, they wholly owned a subsidiary which made 3 million, which is just 0.5% of Tech Mahindra's global revenue. NIT, on the other hand, has been growing quite popular because they also offer English education along with technology, which in turn could be quite detrimental to India because they will create more and more Indian skill sets like Indians have today in this sector. Now, apart from signing the initial $6 million Sino-India trade corridor agreement, there really haven't been any noteworthy news to capture the $500 million Chinese market. InMobi, which is a mobile ad company, has actually made some inroads with over $15 million revenue from the Chinese market. Whereas the banks, if you look at ICICI, SBI, and Axis, they have set up their offices in China, but only SBI is allowed to trade in local currency. All other currencies, all other banks have to trade in international currencies. Many of the other Indian banks are also closing in China due to commercial reasons. Now, the total India investment in China as of September 2019 was only $0.92 billion. Now, if you compare that to Chinese investment in India, which was almost $36 billion. So we're looking at an investment deficit ratio of almost 1:36. India has only 57 companies in China, whereas China has over 100 companies in India. And only companies that can invest over $14 million are actually able to survive and make profit or even break even in China, whereas Chinese companies are able to survive and thrive in the Indian environment. There are challenges in joint venture, labor cost, regulations, government policies, and even local competition with very harsh legal environment. India has to tailor make it export-oriented production to access Chinese market in a resource-based and technology-incentive sectors, whereas Chinese can sell their products as it is. India is far more liberal than China in the manufacturing sector, which is considered a stronghold of China, and they have started to make inroads into that market as well. Now, several exports products of India, which have global competitiveness, have been actually unsuccessful in launching or making inroads into China, despite having strong trade creating effects, which is a very shocking analysis that we have found out. So if you look at the trade imbalance, what have we done so far, right? So we've done some joint ventures. There was some joint venture between CNPC and ONGC in 2005. There was a joint venture between Sinopec and ONGC, which won a 50% stake. That was in 2006. But all the other newses, there's not many significant newses beyond 2007, where India and China have jointly done some projects. Whereas India has been financing and developing Iran's Chabahar port, which also recently has now been lost to China. And India is trying to strengthen now their ties with Australia, Japan, and other countries to sort of balance the trade. India has also taken some steps to reduce the exposure risks. So restriction on pension fund investment, which is now capped at 49%, is coming from any of India's bordering countries, which also includes China. Chinese companies have been barred from providing any telecom equipment to state-run telcos, and any private mobile phone operators are now being prohibited from using Chinese equipment. There's a level playing field for FDI as well. The FDI policies has been amended to bar e-commerce companies from selling products exclusively on their platforms, which means that local shops cannot even sell these. And it also mandates that over 25% of the stock must not be should be from a single vendor, but not more. Now, these and some other steps that are mentioned on these slides will hopefully balance the trade a little bit. But as we have seen in the last 20 years, it hasn't taken much into effect. There were some other steps that were taken in the last 2 years. So there was a talks with Wadhwa Group to buy controlling stakes for $15 million for a township project in Navi Mumbai, which got stalled. There were capital curbs in China for major investments. In 2019, 6 institutional dialogues happened between both the countries for economic cooperation. Obviously, Telecom Department has cancelled the 4G equipment purchase. There's a Baiki planned deal that was for $240 million by the Maharashtrian government, which has now been deferred indefinitely. And some projects have also failed to take off, like the Wanda Group and China Fortune Land Development Group. There was a CFLD $5 billion township project and some other minor projects over the other states. Now, Maharashtra government has also put 3 deals on hold worth $670 million after the border clash. But there's obviously the major concern with apps with more than 100, now I think it's 108 apps that have been banned. But if you look at the net projects that have been canceled in the last couple of years, it's almost 5.4 billion. But still compare that the overall trade and economic relations 36.6 billion. So what are key takeaways from this, right? So there is 3 ways to look at it. There's a risk, which is something that could happen in the future. There's threat, which is happening right away. And also there are a few opportunities, obviously, because we've been trading partners for many centuries. From a risk perspective, I think the trade is highly imbalanced and it keeps showing further sign of skewing. But of late, some steps taken by the Indian government seem to have balanced this trade. I just need to wait for the new financial numbers to come at the end of the year. Chinese investments in India far outweigh India's investments in China. And this can become an issue in the next couple of years. India has lesser investments opportunities in areas where we compete globally together. Chinese investments and trade are being rerouted to other smaller countries. While the trade with China goes down, the trade with these other countries which still trade with China is starting to creep up. Awarding state level contracts to Chinese companies have increased the over dependency on a single country or a single source of supply of resources and solutions, especially in the infrastructure and real estate domination. And also big concerns are around digital and data security, because these platforms can also be used for propaganda, censorship, and diffusion of Indian influence, not only inside the country, but outside the country as well. And controlling companies through debt can really hamper the growth of many economic opportunities. Now, what are the threats that are actually on the ground? So there's a very big blurred separation between Chinese state and the private business. We really don't know where the Chinese government is actually making an investment versus a private company making an investment. You would have heard about the recent Ant IPO being cancelled because of some disagreements between Ant Financials and the Chinese government. So it also means that there's a heavy influence of the government into private partnerships. So when Indian companies are actually signing a deal with a private company in China, are they really signing a deal with that company or actually with the government? And close working of Chinese private sectors and tech firms within Communist Party is also happening to pursue their own goals. Policies and trade agreements that require urgent intervention to balance this trade relation and imbalance that both countries have. Obviously, we can't stop trading with China. They're our neighbors and we have been working together for many centuries. Obviously, the Indian market is a big one for China and it's also a strategic value to them, which means we can use that for our advantage. Whereas the Chinese market is also a big market for India if we're able to make inroads. Now, India is still being, despite the second Silicon Valley of the world, 60% of the top investment unicorns are Chinese funded, and it indicates a huge credit vacuum. So there's an opportunity for India to create more funding opportunities by local investors. There are no major Indian venture investments into Indian startups. China has taken an early advantage of this gap. Capital hungry startups and FDI seeking government is another opportunity for us because this can be used to propel economic growth. China provides patient capital that is required to actually support these startups, which we could continue to use. But what we really need to see is what is the trade-off that we're getting for allowing such investments to happen. And obviously, both countries will continue to gain from long-term trade relations, provided that India restructures the domestic and external policies to ensure effective partnership and trade balance. So while these countries have heavy rivalry in the global market, but any two nations, and this sort of a rivalry can be beneficial for the world economy because we can compete and provide better and better services. Such a massive imbalance in economic and trade relations can actually hurt India's future to stay competitive globally. And with that, I finish my talk. Thank you very much.
So brilliant presentation, very scary also. And at the same time, some thoughts and we'll start off. So first, very good insight is infrastructure does not build economy. Economy creates a need for infrastructure. This is like a complete opposite way, a counterintuitive way of looking at things. I've never heard that before. Any comment you have on that? Because one has always heard you pump money in infrastructure and the economy rises, right from the Great Depression in US to even now. Yes. And I have a series of 2-3 questions.
Yeah. Okay. So look, it was quite funnily, this comment was actually made by a Chinese economist. It was not actually made by an Indian economist. And the Chinese economist was actually criticizing the Belt and Road Initiative. So if you go back, way back, even the Silk Road, if you see, right, we had our camels and horses and donkeys crossing over to China and to other countries to sell our spices and other things. Now the roads didn't even exist, but these creatures walking over and over again, our traders walking, sort of created the road for others to follow. Now, why did they do it? It was because there was a genuine interest and market demand for the products and services that we used to provide. And you also are aware of Chinese students and economists coming over to India, studying in Nalanda University, crossing some of the hardest paths in the world to do it. Now, there's a genuine need, right? There's a gap of knowledge, there's a gap of product and service that fuels this. Now, once thousands of people start to cross it, what would typically happen is that the government would intervene and say, look, I think we need a road here. Let's go build a road. And if you look at major development that also happens for cities and other things, although planning does happen in China, you would have heard of the ghost towns in China too, right? There's whole sets of Paris and Istanbul and all these cities that have been built. There are shopping complexes, schools and everything, but nobody can afford it. So there's nobody living there. So just by building an infrastructure doesn't automatically incite people to come. You need a thriving economy first, where people can afford the services that you provide. So as an example, if most of the Indians cannot afford a $2,000 cell phone, what happens if Apple launches that phone? They create the infrastructure, they create the supply chain, they create the marketing strategy, they create the Apple store, but nobody walks into it because the economic condition of India is different. Today, India is an economic powerhouse and people will not think twice before buying the $2,000 phone. So yes, Apple now has one of the largest markets is India, and they're even starting manufacturing in India, and they're actually moving manufacturing away from China to India. So what that comment actually makes, which is actually from a Chinese economist, is that the economy is the fuel for infrastructure. It demands the infrastructure. It doesn't mean that I can't create infrastructure for economy to happen. But if you only build infrastructure and then somehow magically expect the economy will pick up, there are very high chances that it may not happen.
I have a follow-up question on the investments in the Indian market, especially in the tech spaces. You did list out all the companies, Paytm, Flipkart, and all of those. Some would argue that because India does not have a thriving venture capital network at that stage, at that level of VC investments, and in fact, does India even have its own internal investment network? I don't know, and if you have any data around that, would be wonderful
Yes.
to get. There are only a few large companies who also get heavily criticized. Reliance, for example, is bashed all the time about being a hegemon and all of that, while it's creating some of the best infrastructure in the world for the country. So I'd like a comment on Reliance. And sort of connected with that is, some would argue that if it's money coming in with early investments in Flipkart or Paytm, it ends up creating billionaires in people like Bill, who then eventually become investors with $1.5 billion and start to fuel the next stage of growth, which is all Indian money.
Yeah.
What would your comments be on that?
Very good question. So I'll try to answer the first one, right? So what is seen is that once the companies, so there is a thriving venture capital and angel investment group in India, right? So they're able to fund companies all the way to the point around 80 to $100 million. For some reasons, all these guys shy away the moment these magical numbers are hit. And that's where the companies, so if you look at Paytm, Ola, Flipkart, they all were looking for growth at that phase, right? These are homegrown Indian tech startups that were really, really doing well in the Indian economy. They were actually rivaling Amazon to many extent from an e-commerce perspective, but they actually didn't get any investors in India, and they had to go to Chinese companies like Tencent to actually get the funding. I think there was some other 2-3 companies involved. What surprises me is that why large investors in India are afraid to plunge and take that $100 million deals. Reliance, for example, I would be Reliance, Tata's would be fantastic opportunities for these companies to take stake in these areas. But I think they're also creating rivaling products, which may or may not be doing quite well in those areas. If you see in Australia, is also there's a gap very similar to this, but Australian companies and local investors are starting to form venture capitalistic groups now, like the Angel List that I'm actually part of. 2 Angel List angel investment companies, one in US and one in Australia. We're looking at starting investment around $50,000 from each of the investors. Now, these and more such local investment opportunities with transparency of investments and traceability is highly important, right? So there's a lot of risks involved when people put money into investments in India, and with high level of corruption or bureaucracy, it becomes harder and harder to trace what is going on. I'll give you one example of the Make in India campaign, right? So there was an application by the Indian government to replace applications like TikTok, right? But if you looked at the product brochure that was put on the website, it actually said that as part of the evaluation, you have to show a prototype. So imagine if I'm sitting out of a garage and I am the next Mark Zuckerberg or Steve Jobs, and I have the idea and I can just create some wireframes to show you what the product looks like. The Indian government actually wants a working prototype. Now, where will these people sitting in the garage actually get the prototype? The money to do it, right? So they must take time from their jobs to come and do it, which means somebody has to invest into them. So that's one big problem, is the way the risk-taking attitude, even from the government, has to change, the way they fuel these sort of startups to come. I would recommend that Indian government must provide a platform where all the startup guys have to pay absolutely nothing for the first year to launch their product. Then I can go and all the investors will start jumping on Indian platform, not Azure or Apple to build it. We'll build our own platform and we'll launch our products on our own platform. And we pay a lot of tax to the Indian government anyway, which is going in many other areas, which can easily be funneled into this. The other question was on the $100 million mark. I think this is where very large companies like the Ambanis, the Tatas and others Airtels, many of these who have actually made good of the Indian economy, can create their own funds that can be fueled back into this. Instead of these guys at 100 million going into a Chinese company, and when these companies make profit or even go to IPO, we are the ones who buy the IPO. So who actually benefits are the Chinese companies who have invested in it. So our economy has actually fueled the growth. Our economy has actually created the product, but the profit is going outside the country. So that's why I keep telling this reminds me so much of the East India Company policies that have stayed with us for 200 years. Our bureaucrats probably have learned nothing from it. Maybe we're just continuing what we are doing even then. We need more participatory government between industries to create such platforms if entrepreneurship really has to go up in the tech space.
Thank you. One more follow-up question on the profits going back into China. I mean, what are the repatriation of investments made and money you make in a local economy? I don't know the Indian rules around that, but for example, to repatriate, I run a business also in Philippines. To repatriate money back into India is really hard. So I've made an investment which largely is going to fuel the growth of the Philippines company, but it's very hard for me to repatriate money back. So doesn't the Indian government have rules around that? If that were to be so, then the money would remain in the Indian economy, and even though they're Chinese companies, would continue to fuel growth here.
Agreed. That's a very good question observation. So I don't know if you saw recently, 2 months ago, they caught a Chinese guy who was running an e-commerce business worth millions with a fake Aadhaar card. In fact, he was caught in 2007 or 8. I think he was running, if I'm not correct, $5 million worth of e-commerce through products that were being brought from China. And he was actually sending payments through WeChat and Ant and other platforms, which are openly available to people in India, right? So which means that I could actually make profit and then use WeChat and Ant platforms to send all the money back to China with absolutely no governance from the Indian government. You wouldn't even know that the money is going through, and they could do it in such a way that it would never hit some of the triggers, right? Like for example, if you're going to transfer 1 crore in a day, it might trigger a few alarms. But if I'm just doing 5 lakhs every day or every hour or something like that, then it will never cross the marks that have been kept by EDI or anybody else who's monitoring these transactions. The challenge is that the Chinese have not only created a platform that they can use globally to manage financials, which is why Ant is so successful and going to an IPO. They're also funneling the products to come into India. So, for example, Reliance, right? It has taken a loan which now the Chinese banks have called and in a UK court and said you have to pay it back suddenly out of the blue. Now, the problem is that Reliance has taken this loan where a major portion of it is to buy equipment from Chinese companies. So that means imagine the condition here, right? So I as Reliance have taken the loan, then I go and so I get the loan at very cheap rate. Let's say it's 3%, right? And the Indian banks are offering it at 7%, right? So now I have saved 4%. But the condition is whatever money I got, I have to buy equipment from China, which means I'm legally transferring money back to China. So whatever profit I got from the cheap debt and I made good of my economy is going back to China through the debt. And also because they're also starting to invest in Indian banks, whenever I'm using ICICI Bank or some other bank or HDFC Bank, whenever they trade, they are also making money from that transaction, right? Every time you transfer money between two countries using those banks, they're making money again there. So they're not only controlling the platform, it's like Apple platform, right? Why can't people move away from Apple? Is it because their phone is fantastic? No, their phone is starting to become very crappy, but nobody can escape from the Apple platform, which is why there is a big tech governance meeting happening in US where they're doing Senate hearing on economic hegemony by 3-4 companies in USA, because the platforms are starting to control everything. The way China operates is it is giving you a platform for money transactions. They are investing into your bank, so they make money there. They have technology startups, so they make money there. They give you cheap financials for investments and loans, so they make money there. They also impose that you buy equipment and manpower from them, so they make money there. So, and when the companies declare profits, because they are investors, the profit goes back to them anyway. So look at the thing, the whole economy is happening in India, but the entire benefit is getting funneled out of the country. So this is the holistic interdisciplinary approach that we need to take to look at our relationship with China. It is not about just the border conflict that's happening in Ladakh. You'd also think, why would a country have the courage to come and attack India's border? It's because they know how much control they have over the Indian economy for the investment they have done. So the 40 odd billion dollars they've got invested in India, which is, by the way, a very big investment, and the $52 billion, $60 billion trade deficit they have, which is one of the largest in the world for India, are enough economic controls to dominate a country while sitting outside the country. So we need to look at our policies. So the two different governments, Congress and BJP, have not made much corrections. So it's probably the bureaucrats who are making the decision. So there hasn't been much change or much effect of what they have created.
And what are 2 or 3 things that could change, or maybe the top 5 things? I know you alluded to that. I don't know if you want to open the slide and maybe talk about that, or whatever you may want to do.
I'll bring up the last one, which I think was a takeaway
I mean,
slide.
government, depending on government, Girdharji, is very slow to. I mean, their startup programs, they may bring in some investment, but all of that is going to be very hard for it to become a player like private companies coming in from China.
So I think, see, if you look at the slide that I'm showcasing here, right? China, one of the reasons why China has also succeeded is when they created WeChat, when they created the Facebook alternative, they banned these apps from coming inside their country, right? So I, as Facebook, couldn't go in. So when they created WeChat, they had a full hegemonic control over how those apps could be developed. If I want to term it in a positive way, they were creating a local product with no international competition. When you and I today create a game, when you and I today create an app, we are instantly in competition with the whole world for the same product or service, right? Whereas in China, the environment they provide for those companies, they can create it without any competition. Now, I'm not saying we clamp down our entire trade relations like China is doing, but for local companies and local ideas to reach a point where they can safely grow, we need to offer some level of protection in the market, which is what the Indian government has done with retail, right? So they're saying you can't have all your products being only sold online. You still have to support the local shop owners. You cannot buy all your products for more than 25% by just one vendor, which means that if I control the entire supply chain from China all the way to the e-commerce platform, the customer is Indian, everything else becomes Chinese, right? So that's what they're trying to break. So we need to do similar things across all sectors, right? Well, why don't you look at why we can't fund our own financial projects and infrastructure projects? With $2,800 billion GDP, are we truly saying that the Assam train cannot be built with Indian money? We are I think, in the top 5 economies of the world. Do we really need so much of loans from other countries? Why do we need $500 million loan for COVID from another bank? We are actually forming international banks by going into partnership with China and BRICS and other people to give loan to others, while we are borrowing almost $500 billion worth of money from other international agencies. So it again begs to look at the economic policies that are driving such decisions. While we are lending money to other people, we are borrowing at a higher rate from other banks at the same time, which again creates a vacuum in our space. So I think if we change the policies, if you've got money and you're lending others, you might as well as let your own people borrow. We can also create a safe platform for many of our industries to operate till such a scale, after which I think we need to open it for international markets. See, international competition is always good, because then you come up with world-class products or services. If you isolate somebody to just one country or one state, then you lose that competitive edge. But you must have a place where companies can grow safely. So as an example today, there are only 2 platforms that people going to develop apps. There's Android, there's Apple, and maybe Microsoft is coming up. My question to the Indian government is, why don't we have our own platform? Like we have our own satellites for GPS today. Why don't we have our own cloud offering that all startups in India can use free of cost? Why do they have to be run by private companies? Now, because the moment private companies run these platforms, we are now dependent on them for everything. Tomorrow, if they cut off the cable that runs between these 2 countries, our entire economy, our entire ecosystem comes to a grinding halt. So they get more and more power. And I'm not saying that the private companies must not have power. I'm saying we can create local environment where the millions of Indians who are looking for support can leverage this until they become ready to launch into the big space. So Microsoft can give you 1 year free subscription. I'm sure Indian government can give 1 year to 5 years free subscription for cloud-based services. I'm just giving one example where we can balance this. And also, do we really need critical investments into critical infrastructures from countries that are having such hegemonic policies against us? Why do we need Chinese investments into roads and bridges and trains and other things? Why aren't we looking at other companies to compete in this area? Please remember, they're able to compete because they offer very low interest rates because of the other policies of that they've got around it. So maybe we could get cheaper loans if we are anyway giving loans to the rest of the world. So these are some ideas, but there's obviously a lot more. I'm not an economist, forming policies, but these are some ideas that I wanted to share that people can think of.
So before I put across my question, I'll just like to put a few statements that I got to read, which actually sum up this whole situation perfectly. Like noted historian Will Durant, he warned that just as the British financed colonization of India with Indian wealth, the Chinese are financing their encirclement of India with the profits earned from predatory trade with India.
Yeah.
Apart from that, Harvard's Graham Wilson stated, and this is very scary, that China is the most protectionist, mercantilist, and predatory major economy in the world. So I'll put my question across. The first is regarding RCEP, the Regional Comprehensive Economic Partnership. We are getting to hear a lot about it in certain sections of the media, that even though we have free trade agreements with all other member states of RCEP, it wasn't a wise decision for India to refuse signing the FTA with China and become a part of the RCEP, since its member states constitute 30% of the world population and 30% of the global GDP. So firstly, I'd like you to throw a little light on this. Secondly, my second question would be, why doesn't India, as permitted by the WTO, impose punitive tariffs on Chinese subsidized goods? And secondly, China, while exploiting India's rule of law for dumping, it keeps whole sectors of its own economy off limits to Indian businesses. It has not dismantled the regulatory barriers to the import of Indian agriculture and pharmaceutical products, as well as the IT service. These are 2-3 questions I have. First is about the RCEP, second is about the WTO punitive.
Okay, so I'll try to attempt the second question first. Yes, the trade barriers, as you saw, India has been trying to make inroads into the Chinese market for many years, for the last 20 years, right? So if you look at what we're able to do in the last 20 years is $1 billion worth of business, whereas China is doing almost $40 billion worth of business with us. And the major contribution to this is the economic legal framework, policy framework that is provided within China, which is very protectionist based. It also imposes restrictions by mandating that you trade in foreign currencies or not trade in foreign currencies. So there's a very big hold on that. Whereas when these same companies, the Chinese companies come into India, they don't face any of these restrictions. So Raulji, to go back to the question you're asking me, how I can funnel money out of from my business from Philippines. Philippines government does monitor how you funnel money out from your trade and economics. So does Australia, so does USA. Whereas if I'm using a platform like WeChat and Ant, I can easily funnel money out. So India can very easily block these sort of platforms, or at least monitor them to see what money is coming out. If Ant financials can run in India, why can't Indian platforms be allowed to run where Indian businesses can transfer money through that platform? That will automatically open up economic transactions for Indians trying to establish. There was a survey done in China for Indian companies, from which I based a lot of my research, where they said that unless you invest $14 million into a company in China, you will not even break even, which means you will close down before you break even. Can you imagine every company that goes into China investing $14 million? When Chinese companies open their shops in India, they don't even spend close to $1 million in establishing themselves, irrespective of the size of the company. Why do we need to invest $14 million to establish ourselves in China? If you look at pharmaceuticals and IT, which are our largest exports, you will not see their presence in the top 20 products or services. So unless we are able to trade in our most famous products, so it's like banning Apple from selling iPhones, right? Which is the main product. And they can't sell it in a country because of whatever reasons. So unless these trade relations are made even, the trade conditions are made significantly similar, it will be very difficult for Indian companies to catch up with them. Now, there are many associations that are being formed where China is pushing for more and more conglomeration. What you must also realize is that China is giving debt to many of these countries. So many of them are, they've been sort of pressurized to come into these associations because they owe a lot of money to China. One big question that the world economic agencies and financial institutions must also ask is, how is China getting so much of money? If you look at their GDP in the last 10 years, it has been in a steady decline. They've actually dropped around 6% and going further down. So how does one country generate so much of money that they can give loan to the entire world? That's a very important question for us to ask in international forums. So for example, if Rahulji, you had a business and you kept giving me $10 million every year, at some point I might ask you, how much revenue are you generating in your company? Or how much cash are you printing? How much inflation are you causing in your own country that allows you to give so much of loan? And how are you able to give these loans at 3%? So these are the sort of questions that we must ask in international forums before we sign on and become part of these forums. Because the moment you get into these forums, the same economic dominance will continue. And I'm not saying that China is an evil country or anything like that. What I'm saying is they are using these conditions to make it very profitable for their own people, their own industries, and their own economy. What we should be doing is looking at how can we use better tactics and better policies to make it an even playing field for our own companies, for our own people, for our own citizens, while at the same time avoid exploitation and getting caught into debt traps of cheap debt and investments. So if you don't do these three things, irrespective of which association you go to, like, if you get access to 30% of other countries' GDP, they're all in debt with China. So it's sort of 2 steps away from the debt, so to say, right? You're not at the debt, you're 1 step away. So if those countries or companies collapse, they have a problem. Sri Lanka has come back to us and said, please rescue us. They are unable to get their port out. So they're asking now India to intervene. We've already rescued their airport. So now if you say, I'm going to partner, I can't partner with Sri Lanka because I'm not part of that other group. I think it's better we are not part of that group until they figure out how to deal with China. I might as well as form a better association where we have, for example, Australia is a fantastic country to partner with because both are democratic nations, both have similar political structures, both have similar policies, both are very friendly in nature towards each other, both are multicultural, multi-diversity, secular countries. So it's a great partnership, but we have never pushed for more economic relationship with them than before. And I'm very thankful that now India is looking at more partnership with countries like Australia, which I think will provide a very good competitive advantage. Chinese companies, for example, are now being banned in many parts of Australia. So now Australia is actually looking for more and more economic partnership with companies from India. This is a fantastic opportunity for Indian companies to reach out to Australian companies and vice versa and figure out what we can do together as trade relation partners. But I don't see any trade commissions coming from India, at least because of COVID and other problems. But I'm hoping that by 2021, you will see a lot more flurry of economic activities between these countries, China, US, and other countries in Europe as well.
So, most of it has been answered. The key takeaways. Am I audible?
Yeah, I can hear you.
Yeah. The situation is very scary. How long did it take us to reach this kind of a lopsided equation? And how many decades has it been like this since the beginning? And how long do you think will it take us to extricate ourselves from this?
So if you see in the last couple of years, not the old one, right? If you look at last 30 years, let's say we ignore very old trade relations, right? So if you look at it till 1990, we were almost at the same place. So China got its independence around 1948. We were around 1947. And pretty much we used to have a very balanced trade relations. Something started to go wrong in 1990, right? But until it was the mid 1990s, if you remember, with our economy being opened up with Mr. Manmohan Singh and Narasimha Rao and all that happened, the policies that got set there 20 years ago are what is funneling the changes today. And if you look at this graph is available to all the economists, all the policymakers of the country. All you have to do is compare how China is doing its economy with us. Why are we allowing, since 2000, why have we allowed China to have a positive trade relationship with us? So if you're, for example, doing a trade, if you and I are trading something, if you're always selling me 10 rupees worth of products and I'm selling you 500 rupees worth of product, who's dependent on who more for economy? So if tomorrow I shut down the shop, you're in a very bad situation. If you shut down a shop, it's very easy for me to find another source. So what I'm saying is that the products we may exchange could be different, but we cannot allow a trade relationship to be so skewed for 20 years, right? And if you look at this graph, some people make it politicized. You will see news channels that will show the graph only till 2015 and stop at that and say, I have come into power and I've changed the world. If you just expand your data range to 20 years, you will see that nothing has changed from 2008 to 2020, which means irrespective of who you elect into power, The policies that are being made at the central government, state government, the bureaucrats who are making it are essentially driving the same agenda. So the question to ask is, why is this agenda being driven? How does it actually benefit India? And again, I'm not asking this question as somebody who's going to create quadratic equations in economic numbers to figure out what's going on, but as a layman, like you and I both can see the graph. Would you not be worried if you see that your trade partnership with somebody has such a strong trend for the last 20 years? So the challenge again is democracy is run by the people, for the people, of the people. If we just cast our vote and sit and don't ask these questions, you will not hold the feet to the fire of the governments that are being elected. And they have to fight their internal battles with bureaucrats. Please remember, bureaucrats have employment permanently. They don't get fired just because you don't like them after 5 years. So the way they make decisions is very different from a way a political party will make a difference. Political parties have to pander to the populist vote, whereas a bureaucrat doesn't have to. So what we really must be looking at is what is in the bureaucratic system that is creating policies which are creating this sort of trends and patterns. The good thing is COVID has been a blessing in disguise for many things, although it has been one of the worst things to happen to planet Earth. It has caused a reset. It has caused people to relook at it. And the border conflict that has also erupted is also causing a reset, making people look at this in more detail. If I tried to make this presentation 5 years ago, most of us would have been busy watching Hollywood, Bollywood, and this and that and all that. None of us would have sat down and looked at economic relationship with China so much. But today we can, because we had the time. We are not traveling anymore. We're sitting inside. Everybody participates in Zoom calls without failure. So there is a little bit of change of attention, of span of attention and focus of people to look into this. I would say it's a very good question Aparna asked. You must ask your local government. You must ask your local politicians. You must ask your local bureaucrats saying, why are we allowing such decisions? And remember, these are not central based only. These are also state-based relations. For example, Maharashtra government had 3 big contracts worth over $600 million, all being given to Chinese vendors. There were, I think, 3 or 4 vendors. The cheapest was China. Why is our category for selecting a vendor only on cheapness? Would you like to buy a cheap phone or would you like to buy a nice phone, which is not, like an Apple, so to say, right? That's where we operate. So I'm not saying that everything has to be given to the cheapest person, but if it comes with the hegemony of a debt trap, if it comes with a restriction that all equipment that must be used in the dam or the railway project or the road must come from materials from China, or that the labor also must come from China, why would I sign such a contract? Look at CPEC in Pakistan. They have interest rates of 30%. Can you please tell me which loan that you have taken in your life has 30% interest rate? And at the same time, the raw materials, the labor, the manpower all comes from China. So guess what is happening to the Pakistan economy? I really feel sorry for the local citizens because their economy is getting destroyed at the expense of another country's economy. And if we are not careful, and if we are not monitoring these economic situations carefully, and if we are not looking at the numbers as citizens regularly and asking the right questions in many forums, asking our academicians, asking our researchers, asking our politicians, asking our bureaucrats, if we don't hold their feet to the fire, we will be there in another 20 years. And you'll not even notice that it has happened. So it's a very good question. I think all of us must be very, very careful as we go forward in terms of what we as a country do, especially in international trade relations.
Follow-up question, sir. So if the policies have been such that China has been able to hold such a dominant position over here, I'm sure tomorrow it could be another country if the policies remain the same. Or is it only with China?
So China has been our single largest trade deficit. It is the largest trade deficit we have ever had as compared to any other country. See, for example, we had a lot of dependency with USA for software exports, right? Our whole IT industry, which I was a part of, all developed because of our fantastic partnership with US. But very soon, Indian companies realized that when the first 2001 happened, when the dot-com boom got burst, Indian companies very quickly realized that they cannot depend on one country for the source of the income for that industry. So all IT sector companies started to branch. So if you look at the Tatas, the Mahindras, the Infosys and Satyam, today they have global operations. They're not dependent on one country for their economic relationship. However, their trade relation still is not as bad as with China. We have the largest single trade deficit with China for the last 20 years. Why have we not noticed? This is the question. US has always been in the focus. People are monitoring US very closely, but nobody is monitoring China. Why? Why is it on nobody's radar? Why isn't there on dashboards? Why is it not there in the budget that is released? Why is it not there in the yearly financial reports that come out from state and local governments or even the central government? So this begs a bigger question. So again, as I said, I don't want to go into geopolitical scenarios, wars and other things, because I think many other experts have already covered that. But the economic relations also show similar bias towards this relationship, which needs to be corrected.
One last statement, sir. These questions that you asked in the end actually were supposed to be my questions. I was in the retail industry for 12 years in the beginning of my career, and I saw that we used to get container loads of Chinese goods every Diwali. And I thought that I, as a layperson, as an employee, as a very small employee of a very small store, know this. But how come it is nowhere there in the media? So what is the answer to that?
So as I told you in the investments also, Chinese companies have been buying media companies as well, right? So today we have not asked the media companies to show where their shareholding patterns are coming from. So if you look at Satyam that collapsed, and I was deeply involved during my career with the Satyam collapse, 51% of Satyam holding was from a small island outside of India. Can you imagine one of the fastest growing companies in India being controlled by an unknown entity who's based out of a desk in a building, right? So this is the same problem we have got with retail as well. So you must now ask. So for example, when Paytm became so famous during the deregulation of the currencies, did we really ask who owned Paytm? Right? So now the entire country has moved on to a fantastic platform. So if I was, so let's say it's a great platform, right? Let's say Indian companies have not been able to come up with that platform. And today we're in an economic situation where we have to rush out a digitized service for it. If I was in the central government, I would have bought a major stake into Paytm platform and said, hey, if you want to run in my country, I'm going to control. So for example, when we buy Rafale deal, or when we buy a nuclear power plant from GE, or when we buy aircraft engines, we actually have 20-year trade agreement where we do technology transfer and ownership transfer, which also means that in 20 years, I will also have the capability to manufacture those equipments myself. So if you look at the joint venture between Maruti and Toyota, so Maruti can now run its own brand when we started the partnership. Whereas there's no such partnership with Paytm. Why is digital different from any other industry that we have got? Because it's brand new, I guess, and people have not thought that it is like any other industry as well. So if I was Indian government, I would have absolutely rolled out Paytm, but I would have taken the controlling stake, not Tencent or any other outside company. If you look at Ola, which is collecting so much data about our traffic, who's traveling, your data, your feedback, your phone number, your address, has anyone from here asked where is Ola's data stored? If you look at TikTok, which got rolled out, all your sensitive data, personal data, your kids' data who are creating videos on it, nobody has asked where this data is going. So tomorrow, those videos can be used to create a profile of you. Artificial intelligence has progressed so much that if I feed it a couple of months worth of video, they can actually create fake videos out of you. So we can pick words that you have said, and we can actually make a video. It's called, I think it's called fake personas or something. I'm sorry, I'm not able to remember the name. I can actually create a video which is so difficult to differentiate from the original. And I'm just talking about just one or two such things that are going wrong. So even from a digital security, you know how we protect our borders? There's border force sitting in Ladakh and Jammu Kashmir and protecting it. Our digital borders are very, very porous, which means that they don't have to cross the border, come into your house to dominate you anymore. They can dominate your business sitting from outside somewhere else, because we're not monitoring our digital traffic at all. We are not monitoring investments. We're not monitoring digital traffic. So we need policy changes there as well.
I believe during the CNG games, our website of the ticketing was hacked. And it was somebody in the US who discovered that somebody in China had hacked it. For India was like sleeping.
No. Even if you look at that app that got released for contact tracing in India, right? There was a hacker who actually came up with all the security issues where if you go to the border force and change the kilometer to 10 kilometer, it would identify all the phones in that area. And I know the Indian ministry came back with clarifications. Then they came back with an award which said, I'll give you 5 lakhs or 4 lakhs if you find bugs. My question again is, we run the IT industry of the world. We are the second Silicon Valley of the world. Are you seriously telling me that we don't have technical capabilities to test these apps before they go out? Which begs to say that the industry partnership between state and local governments and central government with the technology companies that run in India has to be deepened, because we have the capability, we have the technology, we just need to mesh them together so they work better in partnerships. So it's the same thing again. It's not that so our company, so Target that I used to work, we used to run 2000 stores of Target sitting in India. So are you telling me that I can't monitor apps for my own government sitting in India? I absolutely can. And Reliance has made so much investments into 5G infrastructure, 4G infrastructure. Today, all of us are able to take video calls sitting at home because of the fiber optics cable that has been laid out. So that means the will is there, the money is there, the technology is there. It's just stitching together critical infrastructure and partnership pieces that we are missing out on. And if we correct those, I think we will solve a lot of the problems we already have.
Yes, hi Giridhar sir. First of all,
Hello,
I would
namaste.
like to commend you for such a comprehensive presentation which you have given us. It is
Thank
such
you.
an insightful into the data. So Girdhar, I have 2-3 questions. So one is related to the 1991 liberalization changes which we done, which you just now mentioned as well. So it is 30 years since then, and I think we have reaped enough benefit from the liberalization changes we have done. So now we have a time come when we should really think about reversing those changes and giving our homegrown companies some advantage.
I think look, I don't think we can completely deliberalize, right? So we've sort of become a global economy. So if you look at 1990, so imagine if COVID had happened in the 1990s, 95% of us wouldn't even know what's happening in other countries, right? I remember as a kid waiting for telephone lines to come for 2 months. Today, I think any kid can walk into a store and buy the phone in literally 5 minutes. And that is due to thanks to the global partnerships we've got across the world, where technology and industrial solutions can come in. So it's very hard to go back. It'll take a lot of effort to go back, but I don't think it's also going to be beneficial to roll it back completely. But your statement is very correct. What I'm suggesting also, along with what you're saying, is we need to create a little bit of safe area where critical infrastructure and critical projects and critical investments can happen without global competition. So it's like a pendulum, right? Sometimes you become so non-liberal that you sort of miss global opportunities, and then you go so liberal that you destroy your own industries locally. So it's sort of a pendulum that swings both ways. But having said that, 20 years is a long time to monitor the swing. I'm not talking about 5 years, right? I'm talking 20 years policy across 4 different elected governments running there. So in technology, for example, we could create our own platforms for cybersecurity. We could create our own platforms for hosting cloud solutions. We could create our own offerings for every app that is out there in the world. And we can give them local incentives to create those products. Why isn't anybody creating a Facebook in India? Look at Twitter and Facebook. Yesterday, they banned, I think, Amit Shahji's photo. Then they'll ban Twitter. Subramaniam Swamy was thrown out of the Twitter. Then now they've blocked Indian military's handle. And we are just sitting there thinking, what do we do? I think it's the right time to create a platform in India for India. If I can have GPS for India, our own satellites, I'm sure we can have a Twitter for India. So what is stopping us from creating that sort of a local environment where we can encourage these sort of initiatives? So again, 20, 30 years ago, you and I were probably not exposed to technology, nor were kids exposed to technology, nor had we traveled around the world and learned these things. But today we have. Today we have the support of international communities. Today we have global partnerships. Today we have investments that come from other areas. We've got the technology stack. We've got everything that is required. All that is required is a willpower and a little bit of policy planning to say, how do we encourage and protect local businesses from flourishing to a point where they can compete in the global market? I would strongly prohibit anybody from saying that, a Twitter competition must not compete at all for many years to come. That is highly unlikely. You get the best of products only when compete. Like, for example, international athletes, why do we go play Olympics? Because you could be a Raja and, king in your own state. The moment you go in Olympics, you realize you're number 11. And that's when you realize your competitiveness and say, oh my God, I'm not at all good. And that changes your mindset and your gear and how you compete. Your training will change, your food habits will change, what you read will change, everything will change, right? So we become better because of competition. So there's no way we should stop international competition that way. We need to compete. But at the same time, when I'm training to compete in the international market, You cannot start putting restrictions on me and say, I can't even run. I can't eat. I can't get up at 5 o'clock. I can't eat that food. I can't go talk to somebody. If you do those, I will never be able to compete in Olympics. So we have to provide the local environment where companies can grow to a certain stage. And after that, they're free to choose, maybe the $100 million mark where most investors run away. In India, I think we are finding investors all the way till 100 million mark is anyway happening. But why not run it from the government itself? Why does it have to be privatized? Or maybe if the problem is that after 100 million, there are no investors coming in, maybe the Indian government can pick up stake and help boost those companies and technologies. So there are many options that way. I would not recommend going back completely to lock the borders and other things. We have to be competitive. We have to work with the world, but we need a safe environment to grow and help our companies and citizens grow to a way where they can offer international class services.
Is this the lack of political will, to put it in blunt words? Is it a lack of political will, or is it the threat of the economy collapsing? What is it that is stopping the government?
I don't think so. If you saw the slides, right? So last 4 governments in the last 20 years, 2 different parties have not been able to make the change. And both have very different fundamentals and different focuses. Yet the situation hasn't changed. So it is quite clear to you that it's not a political problem. So now what we must look at is what is common in 4 governments.
Right.
Who are the decision makers? Who are the people who are actually writing the policy? Who are the people who are inviting policy creation? Right. Who's the one who's inviting tenders? Who's the one who's deciding all of this? If you figure that out, then I think you know the problem. And I think I've given you enough hints for that one as well. So I don't think it's a lack of political will. So let's say if tomorrow we make Tanya Ji the Prime Minister of India, right? You will not be able to move an inch without the support of certain services, whether it's the IPS, IAS, or whatever is there, right? Now, unless you're able to drive change in those services, make them look at India very differently, I don't think it's going to move. Politicians come and go in 5 years, sometimes in 2 to 3 years, as has happened in the 1970s and 80s. But the country didn't collapse and destroy itself, right? The civil service keeps it going. The bureaucrats keep it running. So they do play a very integral part. But it's that group that we need to influence to make the right decisions. We have to take them along the journey.
Right. So, Girdhar Ji, is there any way you suggest that we can get these bureaucrats accountable to, listen to this? And is there something we can do as people, or put pressure on the political ecosystem that we have? That's how. And how do we do it as common people?
So, democracy process is participation by the people, right? So, for example, I'll give you an example from US and Australia. Every time a road is laid here, there's actually an audit that happens, and citizens actually provide feedback on the project. So in the early 2000s, I was part of a group called Janagraha, which actually started to implement this change, right? When a road is laid in your locality, they shut off the road, they do everything. But sometimes you see that instead of 3 layers, they put 2 layers. Now you don't walk into your local BBMP ward or municipality ward and say, I think that road was bad. The guy did a shoddy job. But whereas in other countries like Australia, US, and other places where democracy is thriving, people actually participate. They will walk up to the council, they'll ask for the feedback form, and they'll give the feedback and say, we as citizens of this local area have found that the road is bad. Please do not release the payment until it is fixed. And I'm giving you a very small example. Most of us don't even turn up for election. That's another problem, right? So we start the root cause from there. Democracy only works if we participate. Right? Otherwise, it's as good as any other dictator-driven thing, right? We put somebody in the center and say, that guy will make all the decisions. But remember, our leaders emerge from our own group. It's people like you and me who are on this call, who are the leaders of tomorrow. So what makes you different from others is the support you get from others. So if I support Tanya Ji's initiative, now suddenly you're a leader. If there are no supporters, there is no leader, right? So we have to participate in government. We have to hold our elected officials, which is the democratic process, hold them accountable. We have to hold our institutions accountable as well, whether it's a legal system, judicial system, police system, financial system. You must look at the monthly financial reports that come from your local government. Ask questions. It's not one person asking. When millions start to ask questions, the governments and the bureaucrats will change. If we don't participate and sit away and watch it, nothing will change.